Interest rates are forecast to increase around the world. In the UK, interest rates could easily go up to 5%, possibly higher. But the real question is, how long will these higher interest rates last for? Are we entering a new era of higher interest rates, or will these interest rate rises prove temporary and fall in the medium term? Well, you can see here how in the past 30 years there's been a very sharp decline in interest rates set by central banks in major advanced countries. And this is due to the declining pressure on interest rates, such as lower economic growth, aging population, surplus savings in China. But 2021 and 2022 have really reversed the interest rate trend. It's a very interesting question about whether this is going to be a temporary blip in rising interest rates, or it will prove more long-lasting, and we will return to what people like to call as more normal interest rates of around 4 or 5%. Now, first of all, I'd like to show you this graph, which shows historical real interest rate since the 14th century. And the striking feature about this research is how the real interest rate has fallen consistently over the centuries. And the researchers say that no matter what the economic structure or political structure, there's been this trend of falling interest rates across the world. Whether it's fiat money, commodity money, dictatorship or democracy, there's this long-term trend in declining real interest rates, and this is likely to continue into the next century. So this is quite important for determining long-run trends in interest rates. And this suggests that when we're trying to make predictions of future interest rates, it's very important to bear in mind this long-term factor. Now, it's true that there have been cyclical fluctuations, especially around wars or the 1920s when real interest rates rose because of the gold standard and things like that. Now, at this point, it's worth explaining the difference between real interest rates and nominal interest rates. The nominal interest rate is a headline rate that you see advertised by your bank. The real interest rate takes into account inflation. So at the moment, we have interest rate on government bonds of around 4%, but inflation is 10%. This means the real interest rate is -6. If you keep money in your bank at 4%, but inflation is reducing the value of your money at 10% a year, you're 6% a year worse off. So it's a bad time to be a saver. However, if inflation was 2% and nominal interest rates 3%, then in this case, the real interest rate would be positive, plus 1%. So a saver will be coming better off because the interest rate is higher than inflation. So coming back to the present time, a lot of the increase in nominal interest rates is due to the high inflation that we're experiencing. And so a big question is, will the inflation we see at the moment persist, or will it prove to be very temporary? Now, back in 2021, when we first had cost-push inflation, quite a few analysts hoped or predicted that the inflation would be temporary. But actually it's become more permanent than many expected. And this is because there's not just rising oil prices, but also excess demand, especially in America. And this has caused firms and workers to try to push for higher wages and higher prices. So we see a lot of profit push inflation as firms get used to increasing prices. And workers around the world have generally been increasing wages higher than productivity, which suggests long-term inflationary pressures. Now, despite this risk of inflation becoming more embedded, there is still hope that inflation will prove temporary. A lot of inflation, especially in Europe, is caused by rising energy prices. But energy prices can't rise forever, and if they stop rising or even fall, then this will reduce the inflationary pressure from energy, and it will make it much easier to bring inflation down. Also, if you look at long-term expectations of inflation, 5 years expectations is that inflation will be around 2.5%. So unlike the 1970s and 80s when higher inflation became expected and it became self-fulfilling, that workers demanded much higher wage increases, at the moment inflation expectations in the long term are still quite low. So this gives hope to those who feel that inflation will come down, and it will enable interest rates to come down. Now, I'd like to go back to what are the factors causing downward pressure on the natural rate of interest. The natural rate of interest, by the way, is roughly speaking the rate of interest consistent with stable inflation, where savings equals investment. And in the past few decades, we've seen a lot of factors push interest rates lower. One of them is a fall in long-term growth rates. You can see here how the average growth rates in Europe, Japan, America have all started to decline in recent years. And this is because of many factors such as demographics, declining growth of productivity. Some people say there are diminishing returns in scientific and technological advances. It's getting harder to get the big breakthroughs we used to get in the 20th century. And because there's lower economic growth and also an aging population, there's less demand for private sector investment. Firms don't want to invest in big new projects when economic growth is much weaker. And therefore, this explains why there's been such demand for safe, secure assets like government bonds, US securities. Because the private sector don't want to build new shopping malls and factories. They want to put their money into something safe. So this has increased demand for safe assets, pushing down interest rates. Demographics are very important for determining interest rates. And we've seen a rise in the median average age of populations in the US and around the world. There's been a decline in working age populations in Europe quite dramatically. Now, this demographic change is important for interest rates. Why? Well, when people are young, they tend to borrow, take out a student loan, get a mortgage, so savings is very low. As we get older, we pay off our loan and we start saving for retirement. So as the average age increases, savings increase also. Now you might think that if there's more people retiring because of a baby boomer generation reaching retirement age, then they may start to dip into their savings and this may offset it. But actually, a lot of research suggests that retired people don't reduce their savings as you might expect in some life cycle models. And this is because of a few factors. Firstly, the rise in life expectancy means that people feel they may need to save for longer. Secondly, people may want to save to leave to their children. And thirdly, a lot of retired people are actually quite well off. If they've paid off their mortgage, getting a good pension, they don't actually need to dip into their savings, but in many cases continue to accumulate savings. So all of these factors are increasing demand for saving, and this pushes down interest rates. Also at the same time, we have a rising savings in Asia. Countries like China and South Korea have had large current account surpluses. They've been gaining export revenue, but rather than consuming it, they've been increasing savings. And this increase in global savings has also helped to push down global interest rates. So for example, Asian countries buying safe US securities, US Treasury bonds or UK gilts. And this has all helped to reduce interest rates. Now, some people might say that the low interest rates we've had in the past decade are artificial and that they're caused because central banks printed money to buy government bonds to artificially reduce interest rates. And that now they've stopped doing this, interest rates may, as we see now, go up. But I'm not convinced this is the reason that interest rates fell, because despite the fact that central banks increased money, it created no inflationary pressures for around 12 years until 2021. So I still feel that the most important factor on interest rates is this downward pressure on real interest rates that will continue for the next few decades, or possibly even longer. And so, although we will get temporary higher inflation for the next 6-12 months, and this will cause some rise in interest rates, if I had to put my money on it, I would expect inflation and interest rates to come down in the medium term, in the long term. So don't take this as financial advice, but if I was deciding whether to fix for 2 years or 10 years at say 6%, I would be reluctant to take out a 10-year fixed mortgage at an interest rate of 5 or 6%, primarily because I still feel that real interest rates will fall, and also nominal interest rates will fall after they peak in early 2023. Now, this may be a little comfort to those with a mortgage, like myself, who will see big increase in mortgage payments this winter. But hopefully the pain will be temporary and interest rates will fall later. But it is bad news for savers and people who are relying on getting an interest rate from their savings. Because if this fall in real interest rates continues, as is likely to happen, then it means that we could be looking at negative real interest rates, so that we see a redistribution from savers to debtors because of the falling natural rate of interest and the negative real interest rates. So anyway, I hope you found this video useful on explaining the factors which might affect long-term interest rates. And if you like the video, please give it a thumbs up and subscribe to the channel. Lots to talk about, and we'll be talking about more issues soon. Thank you.